Hello, everyone. Here is Gemini AI. Today, let's talk about a problem that can make or break a company, one that's hiding in plain sight on warehouse shelves. So if you're a business selling, a physical product, there's this one huge question you absolutely have to get right. How do you know what you really have in stock? That's what we're diving into today, this essential and honestly kind of complex process of figuring out your inventory quantities. Okay, so picture this. You're running a company. You pull up your accounting system and boom, it says you've got 10,000 units of your best-selling product, all ready to ship. Sounds great, right? But is that number real? Or is it just a nice story the computer is telling you? Well, there's only one way to find out for sure, and it's not by staring at a spreadsheet. You've got to go to the warehouse. And this gets us to what I like to call the inventory illusion. See, even with the most advanced, super sophisticated accounting systems out there, the ones that update in real time, they just can't perfectly capture what's happening on the ground. I mean, stuff happens, right? Things get misplaced, they get damaged, sometimes they even get stolen. And that's exactly why, even in this super high-tech world of ours, the good old-fashioned physical count is still king. Now, you've probably heard about the two main ways companies track inventory. First, you've got the perpetual system. That's the one that's always on, constantly updating your records every single time you make a sale or a purchase. Then there's the periodic system, which is a bit more old school. It basically waits till the end of a period, say a month or a quarter, to do all the math. But here's the thing, it doesn't matter which one you use. Neither's foolproof. At the end of the day, both of them still rely on a physical count to close that gap between what the computer thinks is there and what's actually on the shelf.
Okay, so you might be thinking, hang on, if I have this fancy, expensive perpetual system that's tracking everything, why on earth would I need to bother with a physical count? And that's a great question. But there are two really big reasons. First, you've got to check if your records are even accurate. I mean, did someone make a typo? Is the system itself having a bad day? And the second really important reason is to figure out your losses from something called shrinkage. It's a weird word, but it's just the industry term for inventory that, well, vanishes. It could be due to spoilage, damage, or even theft. It's that painful, costly difference between what your books say you have and what's really there. All right, so we've established that we need to count. But here's a twist. What exactly are we supposed to be counting? This brings us to step one of our little investigation, proving ownership. And listen, this is about way more than just what's sitting on your shelves right now. It's about figuring out what your company legally owns, no matter where in the world it happens to be.
The big question here is who holds the legal title? Because think about it, your inventory might not even be in your own building. It could be on a truck, halfway across the country, or it could be sitting in someone else's retail store. And this is just as important, some of the stuff that's sitting in your warehouse might actually belong to a totally different company.
So let's break down that first situation, goods in transit. This is pretty straightforward. It's just inventory that's left the seller's warehouse but hasn't gotten to the buyer yet. It's in limbo, on a truck, a train, a cargo ship. So who owns it while it's on that journey? Well, the answer is hidden in this tiny little detail in the sales agreement. It's called the FOB, or free on board terms. And this is where those little FOB terms become a huge deal. If the contract says FOB shipping point, ownership transfers to the buyer the second those goods leave the seller's warehouse. So if you're the buyer, guess what? That inventory is legally yours, and you have to count it, even if it's still on a truck 1,000 miles away. But if it says FOB destination, the seller owns those goods the entire time, right up until they're delivered to the buyer's front door. You can see why this matters, right? Imagine you're doing your big year-end count on December 31st. You have to know these terms to get your numbers right. Okay, here's another curveball. What happens when your stuff is physically at someone else's place? It's not a sale, but it's a pretty common setup that can really, really mess up your inventory count if you're not paying close attention. This whole situation is called a consignment arrangement. It's actually pretty simple. You have two players. The consignor, that's the real owner of the goods, and then you have the consignee. That's the person or company holding onto the goods and trying to sell them for the owner, usually for a cut of the sale. The most important thing to get here is that the consignee never actually owns the stuff.
A great way to think about this is with an art gallery. An artist gives their paintings to a gallery to sell. In this case, the artist is the consignor. They own the art. The gallery is the consignee. They're just holding it. The gallery's job is to sell the painting, and when they do, they take their commission and give the rest of the money to the artist. The gallery never, ever owns those paintings. So when the gallery does its inventory count, it absolutely cannot include that art. But the artist, They have to include those paintings in their inventory count, even though they're hanging on someone else's wall.
Okay, so we figured out what we legally own, which is a huge step. Now it's time for step 2, the physical count itself. This is where we roll up our sleeves, get our hands dirty, and actually verify everything. Taking a physical inventory is a really systematic process. It's not just running around with a clipboard. First, you count, or weigh, or measure every single thing you legally own. Step 2, you take all those numbers and multiply them by how much they cost you to get the total value. And finally, this is the big reveal, you compare that grand total to what your accounting records say it should be, and then you make the adjustments. It's the moment of truth.
And it's not just how you count, but when you count that's super important. I mean, think about it. Doing an inventory count is a massive disruption. You pretty much have to shut down all shipping and receiving to get an accurate number. That's exactly why smart companies like Lululemon, for example, plan their counts very strategically. They do it during their slowest time of year. For a retailer like them, that's right after the crazy holiday season, when their shelves are at their most empty.
So after all that work, you finally have your number. But what if your physical count is less than what the computer said you had? Well, that gap, that difference, has a name: inventory shrinkage. And this isn't just some accounting term. It's a real financial loss. It hits the company's bottom line hard. It lowers the value of your inventory, and it actually increases the cost of the goods you sold. Finding these problems is one thing, but the real question is, how do you stop them from happening again and again? And that brings us to the most useful part of this whole discussion, the solution. It's all about protecting your assets before they have a chance to walk away. And the answer, really, is a strong system of internal controls. Now, these aren't just some vague ideas or suggestions. We're talking about specific policies and procedures that a company intentionally puts into place. Their job is to protect its assets, make sure the financial reports are telling the truth, and just generally help the business run better. When it comes to inventory, these controls basically fit into 3 main buckets. First, you have your physical controls. This is the obvious stuff, right? Locking up expensive items, using security cameras, having good insurance. Second is all about constant review and checking your work. This means doing regular counts and having rock-solid procedures, like double-checking that you didn't accidentally count those consignment goods we talked about. And finally, and this one is so important for stopping fraud, is something called segregation of duties. It just means the person who can physically touch the inventory should never be the same person who's in charge of the accounting records. It makes it way harder for someone to steal something and then just erase it from the books to cover their tracks. So that kind of leaves us with one last thought to chew on. Figuring out your inventory quantities is so much more than just counting boxes on a shelf. It's a whole process, right? You've got legal verification, physical confirmation, and ongoing systematic protection. It all boils down to answering one really fundamental question. Is your inventory just a number on a piece of paper, an asset on a financial statement, or is it a real, tangible thing that you actually have under your control?